This is a special edition of MacroVoices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of MacroVoices, here's hedge fund manager Eric Townsend.
MacroVoices Energy Week, episode number 3, was recorded on Wednesday, May 22nd, 2019. I'm Eric Townsend. For our third episode of Energy Week, I'll be joined by author and consultant Anas Alhajji, petroleum geologist Art Berman, and commercial broker Pat Hemsworth. Topics for this episode include an update on rising geopolitical tensions with Iran and elsewhere, backwardation of forward curves sending a signal that's at odds with front-month price action, and the Brent-WTI spread, what drives it and where we can expect it to move from here. But first, let's dive right into the EIA weekly production data. Crude oil building 4.7 million barrels. That was an unexpectedly large build. Cushing, Oklahoma, also an unexpectedly large build of 1.3 million barrels. Gasoline, also a massive build, building 3.7 million barrels as distillates built 768,000 barrels. So we've got builds across the board, and needless to say, the resulting tape action was down with RBOB gasoline getting hit the hardest. Both RBOB and the crudes closed well below all of their short-term moving averages, suggesting that further downside is entirely possible. U.S. production ticked back up to 12.2 million barrels after 2 consecutive weeks of downticks. Imports, 6.9 million barrels, down a little bit from last week. Exports also down on the week to 2.9 million barrels, or about 20.5 million barrels of U.S. crude oil exported on the week. Now let's meet this week's expert panel. Dr. Anas Alhajji is an author, keynote speaker, and energy markets expert. He was formerly the chief economist for NGP Energy Capital Management, and he also taught energy economics at the University of Oklahoma and Colorado School of Mines. Anas, the rising U.S. dollar and declining Chinese yuan are products of the China-U.S. trade war, but we seldom hear macro analysts discuss their implications on the global oil market. So please give our listeners a primer on how currency exchange rates affect the oil market.
Absolutely, Eric. Oil is priced in U.S. dollar. Other countries convert their own currencies to U.S. dollar to buy oil. If their currency is depreciating against the dollar, now they need more of their own currency to buy a barrel of oil. In this case, oil is more expensive than before, even when the price in dollar remains the same. So here is an example so people can understand what's going on. Let us start with a price of oil at $70 a barrel, and an exchange rate of, let's say, $1 to 6.5 Chinese yuan. In this case, the price of a barrel of oil in US dollar is 70, while in Chinese yuan is 455. Now let's assume that oil prices are staying the same at 70, but Chinese yuan depreciate where $1 US equal to 7 yuan. In this case, the cost of barrel of oil for the Chinese goes up from 455 yuan to 490. In this case, the cost of oil in China went up by almost 8%, although oil prices are staying the same worldwide, which is exactly the percentage of currency depreciation. Here is the irony of this. While the cost of oil in China is going up, the cost to Americans stay the same. So if trade wars are leading to higher US dollar and lower Chinese yuan, then the Chinese are paying more for oil, while Americans are not being affected. But there are other implications. For example, for the sake of time, I'm going to mention this quickly. Higher US dollar makes oil expensive in other countries, and therefore reducing oil demand, global oil demand. Higher dollar, and this is kind of a very interesting idea that a lot of people are not aware of. Higher dollar reduces the cost of producing oil in some areas, such as the North Sea and Russia, because companies working in those areas pay most of their cost, almost like 60% of their cost, in the depreciating local currency while they sell their oil in the appreciating US dollar. If this lasts long enough, they will increase production. So there are many other details we don't have time to explore today. But before I end, I just want to point out an important point. When talking about oil pricing in dollar, won, or any other currency, we have to distinguish between pricing the oil in dollar and getting revenues in non-US dollar. In reality, all oil worldwide is priced in US dollar, but some countries are using other currencies at the prevailing exchange rate to get other currencies as revenues. For example, Saddam Hussein did not price Iraqi oil in euro. It was priced in dollar and the revenues were converted to euros. The same applies to Venezuela and Iran today. Their oil is priced in US dollar. As for China, it is clear that the yuan pricing within China of oil is tied to the dollar pricing in other markets. The bottom line here is, in the examples I mentioned, higher dollar reduces demand and increases production, which is theoretically bearish and leads to the inverse relationship between the value of the dollar and the price of oil. But notice that this is not a short-term relationship. This is a midterm and long-term relationship. I believe the hourly and daily or this short-term relationship that people and traders work on is made up. It has no theoretical foundation. And it is the product of special circumstances of the financial crisis in 2008, 2009. Of course, one more point quickly to mention that some oil producing countries peg their currency to the dollar. So with higher dollar, they get higher purchasing power for their oil exports. That applies to Saudi Arabia and the UAE, for example. So this is kind of briefly what the relationship is.
Thanks, Anas. Let's go ahead and meet our second panelist. Pat Hemsworth is a commercial broker with Paragon Global Markets, and her decades of experience in both the paper and physical markets give her tremendous insight into the dependencies which exist between those markets. Pat, as you and our listeners know, this time of year is known in the oil industry as turnarounds or refinery maintenance season. In other words, this is the time of year when refineries shut in some of their refining capacity to reconfigure their systems to produce summer grades of gasoline and other finished products. Pat, as we approach the end of this season, how does the United States look in terms of product inventories, and what are the prospects for crack spreads, distillate versus gasoline spreads, as well as crude demand?
Well, we had a very exciting day today here, and we had a very exciting report that came out today. And basically, we found out that instead of going into the turnarounds actually winding down, we went down in utilization by almost a percentage point, and that was due to some refinery issues in PADD 2. But we are in the period when we will gradually come back. We're at about, let's see, where are we now? We're at 89.9%, so about 90% of utilization. And what we're seeing in terms of product inventories are distillates are 4% below last year at this time, and gasoline is just about at the 5-year average. So looking at the country as a whole, we have adequate inventories, but we have had a lot of disturbances in terms of geographical areas. For example, in PADD 2, we've had so many issues with the planting season. And because of flooding, there has been a low amount of diesel usage there. And as a result, PADD 2 distillate inventories are way above normal. In fact, they're at the top of the 5-year range. We just came out of a very crazy period in PADD 5 where the refineries went through planned turnarounds. But in addition to that, there were several, actually refinery after refinery had different kinds of unplanned outages. So at one point, about 3 weeks ago, we were trading at 60-cent premium to New York. And so what happened as a result is many, many cargoes from all over the world, Netherlands, Japan, India, Colombia just converged. They were all coming in right now, actually, to Pad 5. And that pulled a lot of inventory away from Pad 1, which is the East Coast. And so we had RBOB shortages, but that's all beginning to normalize now. One of the things that we're seeing that pulled the utilization down was a number of unplanned outages this week. BP Whiting, which is a mid-continent, Pad 2, and also Exxon Toledo. So what we're seeing now is basically the market trying to come out of this period and into the gasoline consumption season. And so far, after a pretty bumpy ride, it looks like we're pretty well positioned to have adequate supplies. One of the things that we saw in this week's report was that Pad 1, which was extremely low in RBOB, that's our benchmark for futures, got an increase of almost 2 million barrels of RBOB. So we're normalizing there. Also, we have to say Pad 3 is, Pad 1 is still kind of low, and also Pad 5 is kind of low, but Pad 3 has huge gasoline stocks right now. So what's happening there as well, they're trying to ship up to New York where it's needed, but the pipelines are pretty much full, so they're allocating supply going up to New York. So I would say that that's it. We are also looking at the European situation where the contaminated Urals have caused some interruption to refinery operations and have caused drawdowns of stocks. We had a lot of volatility in gas oil. So we're watching those interrelationships to sort of determine different opportunities for arbitrage. But so far, that's pretty much the scoop. Crack spreads also still, distillate is trading much stronger than the gasoline. It's about a $4 premium on the crack spreads for July. And so gasoline is now trading at $20. So that's where we are.
Thanks for the update, Pat. And just to let our listeners know, Pat is obviously on a busy trading desk this afternoon, hence the background noise that you hear. Let's move on to our next panelist. Art Berman is a petroleum geologist who spends most of his time drilling oil wells, but he's also become a favorite keynote speaker and consultant to investors. Art put together a slide deck for today's show, and you can download it from our homepage at MacroVoices.com. Art, my question for you is about shale production. Rapid growth of shale production literally made the difference between what could have become an oil shortage crisis in the 20-teens and the persistent global oversupply condition, which we actually got instead. I would contend that shale really is what caused that difference to occur. Now, a lot of people assume that shale production will continue to grow and that the oversupply will therefore persist. Art, is that prudent thinking, or should we be concerned about a supply crisis in coming years if shale production growth cannot be sustained on the scale that many analysts assume that it will continue?
Right, Eric. Well, that is the key question. And by the way, I completely agree with your assessment that basically shale or tight oil production has bought us as a world about a decade of supply that really nobody thought was there or we would have available to us not so many years ago. Having said that, I think that the assumption that this is just going to go on for years and years and years is completely unrealistic. I've looked in great detail at the EIA's annual energy outlook cases or scenarios, if you will. And their reference case, I think, is, I'll be polite and call it unrealistic. This case calls for U.S. production to increase all the way out to 2031 and to reach a peak of more than 15.5 million barrels of crude and condensate a day. The piece of that ends up being tight oil or shale is something like 10.25 million barrels a day by 2031. And then it only declines at something like less than 1% per year out to 2050. So you can see that reference case in my slide number 2. Slide number 3 shows why I think that's really kind of dumb. First of all, the decline rate that I just mentioned is is silly. But what I show in slide number 3 is a plot that depicts where our proved reserves of tight oil are today, which are about 20 billion barrels, and where this forecast that I showed in slide 2 takes us. And basically, it depletes all of our proved reserves by about 2023. And somehow we've got to come up with 92 billion barrels beyond what's proved today. Now, I don't have any doubt that reserves are going to grow. I'm not saying that. It's just that an almost five-fold increase at the current maturity of U.S. tight oil plays, I think, is a little bit much to imagine. And so what I'm going to show in slide 4 is there are a number of other cases that EIA presents, and 2 of the others are, I think, much more reasonable. This is actually the low resource and technology case, and it, in fact, has U.S. oil production peaking sometime around 2022, and it has tight oil peaking just a little bit after that. The U.S. peak is going to be about 12.84 million barrels a day, which is slightly more than about a million more than we're at today. And then it declines at a more rapid rate. So bottom line, end of story is, I think we've probably got something like 2 or 3 more years of production growth, albeit slower production growth. And then we're going to find ourselves kind of right back to where we thought we were a decade or so, which is to say, where's the next barrel going to come from?
Well, Art, thanks for the update on that. We'll dive into our first discussion topic, geopolitics, right after this. For our first major discussion topic this week, geopolitical risks are heating up, and President Trump's weekend tweets alluding to the possibility of military action against Iran led to a gap-up open for crude oil futures on Sunday evening. Without a doubt, there is no limit to how much price upside is possible in a military conflict that truly threatens global supply. But does a conflict between the United States and Iran truly threaten global supply when Iranian exports are already suppressed due to sanctions, and Iran's arch-rival, Saudi Arabia, is strongly motivated to increase production in order to prevent a price increase from deterring the U.S. from engaging Iran in military action? And of course, Iran is Saudi Arabia's biggest rival. Let's ask our expert panel. Dr. Anas Alhajji, please fill our listeners in on all of these developments, and particularly whether or not they truly represent risks to global oil supply.
Well, there are risks, as we have seen last week with the attacks on the oil tankers in Fujairah in the UAE and the pumping stations of the pipelines in Saudi Arabia. And as you know, the Saudis blame the Iranians, or at least some group of Houthis that is backed by Iran. So the issue here is looking at those 2 events, there is something that is common in between those 2 attacks. And what's common is both attacks happened on facilities that circumvent the Hormuz Strait. Because Al Fujairah port and the pipeline that goes from Habshan in Abu Dhabi to Fujairah circumvent the Hormuz Strait, and the pipelines going from east to west in Saudi Arabia circumvent the Hormuz Strait. The idea here is very simple. The biggest card in the hand of Iran is the Hormuz Strait. If those countries circumvent that, then Iran has nothing to bargain with. So it is very clear that we may not end up with a major war, we may not end up with a major attack, but those little games basically increases the risk.
Thanks, Anas. Let's move on to Pat Hemsworth. Pat, what's your take on the geopolitical situation?
Well, I actually think I'm thinking of it more in terms of the United States side. And I think that if President Trump's sort of obsession is the wall, I think that Bolton's obsession has been Iran. And I do not think, from the kind of vibes that we're getting from the White House and what is actually supposed to be leaks from Trump himself, that he is not particularly happy with this turn of events and is not really interested in a war, and is making lots of sounds about wanting to have discussions and with Rouhani or the Ayatollah. So my feeling is that whatever the administration can do to save face and to back off from this, that's my sense. I don't think that they really want to be backed into a corner, and it looks as though that might be happening.
Thanks, Pat. Art Berman, what's your take on the geopolitical risks?
I really agree with both Anas and Pat. My sense here is that I don't know how much Trump really knows about oil, but I know that he really doesn't like high oil prices. And the way that the Iran situation is unfolding can only lead to higher oil prices. Basically, the price rally that we've been experiencing since really the very end of 2018 was pretty much over until this Iran situation emerged. And right now, again, the market reaction to it was muted compared with what it might have been, a couple of years ago, but still, it's kind of brought new life to this price rally, and obviously, any kind of escalation will make that even more so. So I'm with Pat on this. I think that Trump is in full campaign mode, as he almost always is. He hates high oil prices, and if there's a way that he can find a way to save face and make this situation nicer, that'll get him back closer to where he really wants to be. The other thing is, I really believe that Iran is not his top policy item right now. It's a good place for him to look like a strong guy, but my sense is that Venezuela and China are where his attention is. And if he's anything like most of us, paying attention to three hot spots at the same time is pretty tough. So obviously, I don't want to see a war. I don't think Trump wants to see a war. I think he's going to find a way to smooth this over. At least that's my hope.
Thanks for that, Art. We'll be back with our second topic, which is the disparity between front-month prices and forward curves, right after this. Our next discussion topic will be to analyze why front-month price action seems to be out of sync in recent weeks with steepening backwardation in the forward curves of both WTI and Brent crude oil. Since not all of our listeners are futures traders, I'll introduce this segment with a quick refresher on the concepts involved. Commodities are priced for each separate delivery month. One contract determines the price of WTI crude oil for July 2019 delivery, for example, while another contract sets the price for August delivery, and many more contracts set the prices for delivery of WTI crude all the way out to 2028. If you plot the prices of each successive contract on a chart, that's known as the forward curve or term structure of the market. When prices rise from one month to the next, that relationship is known as contango and indicates that supply is plentiful. But when price falls from one month to the next, that condition is known as backwardation and indicates that supply is tight or expected to become tight. A widely held belief is that changes in the forward curve are effective at predicting changes in front-month price. When contango is developing or increasing in magnitude, lower front-month prices are predicted. Conversely, when backwardation is steepening, front-month prices are predicted to increase. But for the last several weeks, backwardation has been increasing in both Brent and WTI forward curves, seemingly predicting a rise in front-month prices. Yet curiously, during this same time period, front-month prices have traded sideways to lower, definitely not higher. So something doesn't add up here. Are the steepening backwardated curves of both WTI and Brent telling us that front-month prices are badly undervalued and perhaps about to surge much higher? Or should we interpret this curious discontinuity in the data to arrive at a different conclusion? Let's ask our panel, starting with commercial broker Pat Hemsworth. Pat, why is it that these numbers don't seem to jibe with one another?
Well, I think that certain things are going on in the physical market that are indicating that demand for physical crudes are very good. And if we look at various different grades, we're seeing that continuously we've had premiums in various different heavier crudes and non-light sweet, which is our benchmarks crude. So they have been gradually pulling up the futures. And I think that what we saw actually for about 3 weeks is just a kind of smooth sideways movement, whereas underneath the surface, almost like a duck floating on a smooth surface, underneath there's mad movement. And so we've been seeing this flip, and this partially corresponds to what's going on in the seasonal refinery picture. We are coming into a period when demand is higher. And, when the refineries come out of turnarounds, they'll be using more crude. And so I think a combination of the perception of supply risk and the seasonal factors that we're facing right now are causing the front end to be relatively steadier. We're seeing it more so in Brent than we are in WTI, and that's partially a function of the structural differences in the storage in the United States. We have massive storage here. We have a very wide premium right now in Brent to WTI, and I think that's partially a function of storage. But yes, I do think that this is a sign that the market is really positioning itself for a move higher.
Okay, so Pat says getting positioned for a move higher. Art Berman, you have been on record as saying you really don't think that the market is getting ready to move substantially higher in price. If that's your outlook, what do you make of these forward curves that seem to be suggesting the opposite?
Well, let me say first, I won't and could not dispute anything that Pat just said. Aside from the fact that she's more of an expert on all of that than I am, I mean that's what I'm seeing also. And so let me make sure that everyone understands my position. I'm completely on board with the notion that supply is tight. And I'm also in full agreement that the heavier grades are particularly tight. So where I suppose I differ from some analysts is that I don't see the upside being all that great. And the reason for that is not so much the forward curves, but the comparative inventory that I bore people about all the time. And what that's telling me is that in order for prices to get substantially higher, and let's just say for fun, $80 Brent, $70 WTI, we would have to reduce inventories to pretty much all-time record lows, well beyond where they were last year in May, which was the minimum for the last 5 or 6 years. Now, that's possible. I'm not saying it's impossible. Anything's possible. All I'm saying is that for people that are calling ultra bullish kinds of forecasts for $90 Brent or something like that, there's an awful lot of inventory reduction that has to occur before that happens. And let's look at what happened today in the storage report for the U.S. for the week ending May 17th. We had another big increase in comparative inventory. We had a substantial build in crude. In fact, we had a build in everything that I follow except residual. And I understand that there are refinery issues and things like that. But, this has been going on for a while. We're going in the wrong direction. So I'm not arguing against what Pat has just said. I'm just saying that we're sure not seeing that. I'm not seeing that in WTI. And when I do comparative inventory work on Brent, I see a similar situation over there, that it's just going to require an awful lot of drawdown, which is possible, but an awful lot of drawdown to get to the levels that some people are calling for.
And finally, Anas Alhajji, we've got the Brent and WTI forward curves telling us for weeks and weeks now that prices should be moving higher, but it hasn't really happened. What's going on?
Yes, first of all, do I think that Brent will hit 80 again this year? The answer is yes, and I have an explanation for that. But I have a theory about what's been going on, and I don't know how right it is, but I think what's been going on is, in anticipation of the Iran sanctions, several Asian countries, whether governments or companies, been stocking on oil. They were building inventories. And analysts basically misunderstood this, and they thought that was a strong demand in Asia. but it wasn't. It was just the buildup in inventories in anticipation of the sanctions. So all the models basically were looking at that tight market because the demand in Asia is very strong. But it wasn't consumption, it was just demand, and most of it went to storage. And the idea here is now those countries supposed to come back to Saudi Arabia and Kuwait and UAE and others to ask them for replacement for Iranian oil because supposedly they are no longer importing from Iran. But only one company showed up, and no one, those usual customers of Iran, did not ask any of those countries for replacement. What that tells is that either they are still importing from Iran in one way or the other, or they are planning on using those inventories they built in recent months. And that goes back to Art's argument that the market is not as bullish as some people think, simply because the strong demand was a kind of a fake signal because it was for storage. And now that demand is going to revert to a supply. They are going to dump that oil on the market probably over the summer months, preventing oil prices from hitting 90 or 100 or any of those bullish sentiments. So I think it could be this dynamic of the pre-sanction, after-sanction thing that is messing up this relationship between current prices and front months.
Thanks, Anas. We'll be back with our third and final discussion topic right after this. For our final topic, we're going to discuss the Brent-WTI spread. Many years ago, Brent traded at a discount to WTI, partly because WTI was considered a superior grade of crude oil versus Brent. But in recent years, WTI has traded at a discount, sometimes a very significant discount to Brent. As of today, WTI in the July contract is trading at a $9.49 discount to Brent. But what fundamental factors determine this spread, and how can we expect it to evolve from here? Let's ask our panelists to weigh in, starting with petroleum geologist Art Berman.
Eric, this is a fascinating subject that I've followed for many years, as I'm sure the other panelists have. And my bias on all of these things is to not just to look at the Brent premium to WTI and its evolution over time, but to look at this with relationship to the 5-year average that we've seen. And what I see here is that the premium, while it was positive, was pretty much consistent with the 5-year average premium up until really last fall. Sometime in September is when that premium started rising above the 5-year average, and it rattled around and in various amounts at or above that. And where things really got kind of crazy was in late February, and we're still in that mode. We're well above or above the 5-year average since then. So I think that the issue here is principally oil quality, as you introduced it. And so we have a situation where, despite the fact that technically WTI is higher quality, it's higher quality in terms of its low sulfur and the ease with which you can make light end products like gasoline, but it's not higher quality to manufacture diesel and bunker fuel and things that really drive the market. And certainly you've got to have the heavy stuff to blend with it to even have hopes of making distillate out of it. So to me, the spread, the premium that Brent has to WTI, certainly in the last several months, is the market's acknowledgement of the fact that, in fact, crude quality does matter, as people like Anas and I have been trying to hammer home for quite some time. And just being able to produce 12 million barrels a day, as we do in the United States, doesn't mean that oil is as useful and therefore as valuable as the heavier grades for making refined products. Because, I mean, let's face it, a barrel of oil by itself, you can't use it. You've got to be able to turn it into, to gasoline or distillate or kerosene or something so that people can use it. So that's my sense. So the market is saying, hey, we don't have enough of the stuff we need. We've got too much of the stuff that we only sort of need, which is WTI, U.S. light oil, and that's the reason that there's been this disparity and therefore the Brent premium.
And Pat Hemsworth, what's your take? Why the big discount from WTI to Brent, and where's it headed from here?
Well, the spike really happened after it was announced that there would be no extension of Iranian waivers. So it affected the Brent disproportionately. And I also think that some of the chaos in Europe, as far as the contamination of Urals, is a factor, not a primary factor, but a factor. And contrasting that, we have huge storage in the United States and also very high production. And so I think structurally there is a skew towards the premium of Brent to U.S. crude. But one interesting thing is we could talk about the premium of Brent to WTI on a spot basis or July futures, which is around $9.50. But if we go out on the curve, we find out that the premium is much narrower. And why is that? Well, okay, if I go out a year, if I go to June 20, the premium is $6.60. Well, I think that is a reflection of the fact that the U.S. will be organized, its infrastructure, pipeline infrastructure, and port facilities for export will be more highly developed and will be able to export more of the U.S. crude. So, I mean, I think that is built into the structure of this. You could say that there's a wall for U.S. light shale crude and maybe this is improperly priced. But I think this is what the market is reflecting, the fact that the U.S. will be able to export greater amounts of its own crude from a midstream perspective, from a logistical perspective. And I think this is pretty much where the market tops out at around $10. I think that is where people begin to try to figure out how to buy more of this U.S. crude.
Okay, so Pat says we are probably done here, approaching $10 and unlikely to go to a bigger discount than that for WTI below Brent. Anas, what's your take?
Of course, they covered most of the points, but I would like to add a couple of points. To go back to your introduction, when you said that WTI was sold at a premium to Brent, and then we have the reversal. If you go back, you find out that it is timed with the share revolution. So it's really the share revolution made that reverse, and the share revolution basically caused that big price differential. And notice that the largest price differential we had just before President Obama lifted the ban on exports. So exports kind of relieved the pressure on this, and it got lower and lower. But we were not able to go back to what we had in 2007 or 8. But there are other issues. I think Pat alluded to refining wall, which is a very important factor. But there is another factor, which is WTI of today is not similar to WTI of 10 years ago. In a sense, the WTI of today, aside from crude quality matters and all these issues that we talk about, this is a completely different aspect, that the quality of WTI of the same API is not the same. It has more impurities than in the past. And that could be another reason. Then, as you know, we have those contamination issue, not in Russia, the contamination issue with U.S. condensates that gives the impression to foreign refiners that U.S. crude probably is not that pure as we had 10 years ago. You heard about the 2 tankers that South Korea basically returned and they refused to accept because of those impurities. So I think there are several factors at play here in addition to what my colleagues said.
Okay, Anas, thank you so much for rounding out that discussion. Meanwhile, listeners, we need your help putting the word out that there's a new podcast in town and that we intend to become the definitive weekly information source for energy traders, investors, and others interested in energy markets. You can subscribe to Macro Voices on iTunes or at macrovoices.com, and you'll also gain access to our Thursday night podcast, which has a much more general, broader macroeconomic focus. We're also looking for sponsors so that we can keep all of our Macro Voices content free to the listener. If your company is interested in sponsoring Macro Voices Energy Week or any of our other content, please email me at info@macrovoices.com. Before we close, I want to ask each of our panelists what they're going to be watching for in energy markets in the week ahead. Anas Alhajji, you're going to be speaking in Shanghai about the subject of pricing oil in dollars versus other currencies. Please tell our listeners what that's about, how they can attend if that's possible, and also what you'll be watching for in energy markets in the coming week.
Unfortunately, this is a private event for the Shanghai Energy Exchange, but the idea is very simple here. As you know, China is trying to establish the yuan as a kind of a petrocurrency. Other countries tried this and failed, like Iran and Venezuela, and there were some efforts by Russia in the past. The issue here is that no matter what, oil will remain priced in US dollar. Any efforts at this stage to price it in any other currency, it would be just the equivalent based on the prevailing exchange rate. There will be no price discovery. Price discovery is made in US dollar. But let's assume that if there is a price discovery in yuan, for example, that price discovery will not last more than a day or two because people are going to play the arbitrage between that price or the currency's exchange rate, and then they will equalize again. So basically, the whole point here is at this stage, given everything we know about the monetary policy of the United States, monetary policy of other nations, the liquidity of the dollar, and other things, it's very hard to see other currencies basically taking over the pricing of oil. As what I'm watching in the next week, basically, I think it is very important to watch what's going to happen to refineries in the United States because that's really going to make it or break it for oil prices.
Okay, Pat Hemsworth, what are you going to be watching in the next week?
Okay, what I'll be looking for in the next week is to see what happened with runs. I'm also going to be watching the movement of gasoline cargoes that were sent here to see where they go and, if we get more supply in Pad 1, which is where our benchmark is located, New York Harbor. I'm going to be watching the WTI Brent spread, which I think is getting very close to, as I mentioned before, to the top. And I'm watching always the intermonth spreads for products. And we're getting very close now to the expiration of the June products. And what we're seeing is that gasoline came off pretty dramatically from its highs, but the June, July, which is kind of a marker of the near-term supply situation in New York Harbor, that is holding at 200 points. So I'll be watching that to help clients figure out where to roll their shorts or, to position themselves out of the June into the July. So, yes, I'll be watching the spreads. I'll be watching WTI Brents. I'll be watching the movement of cargoes, and I'll be watching the various different refineries to see how we're doing. Another thing I want to watch is what's happening with the farmers. Because on May 24th, I think, is what the USDA kind of put as a date that beyond which corn really can't be planted, or the farmers need to make a decision. So there could be shifting, into other crops from corn, or there could be farmers just receive disaster payments that will affect the demand for diesel, which is really built up in Pad 2. Everywhere in the country, we're way below normal except for Pad 2. Well, I shouldn't say way below. We're overall in the country 4% below where we were last year, and we're on the bottom end of the 5-year range for distillate. But Pad 2 is sort of skews things the other way. It's at the very top of the range. So we want to see what the demand is there, and that's going to affect all of the movements in products. So that's what I'm looking for.
Okay, let's move on to Art Berman. What are you going to be watching in the week ahead?
I don't have a lot to add to what Anas and Pat have said because I'm looking at the same things. But in addition to what they talked about, I remain fascinated by the fact that this price rally that began at the end of last year has proceeded with such a relatively low level of interest, open interest, if you like, from the financial community. So, at least the public financial community. And so it looks like they're getting more engaged, but I'm just a little bit bewildered by the fact that we've had a really good run on both WTI and Brent prices, and yet we're just not seeing a lot of commitment from the managed money or whatever you want to call those large financial sources out there. And I don't know what that means, except that for all of the talk about tight markets, and as I said before, I'm not disputing that, but I'm just not seeing that reflected in the US storage report or yet in the monthly Brent data. And I'll close by saying that, like many people, when Khalid Al-Faleh speaks, I listen, and he's saying sort of a similar thing. Now, I don't know how to interpret that, but he's saying that he doesn't see any reason to produce more oil because inventories are adequate, and he wants to draw those down. Is that purely a profit motive that he wants to get a higher price, or is that perhaps he's a little bit hesitant that the market, in fact, needs more oil at this moment, possibly for reasons that Anas mentioned, that people that buy oil, they've seen this coming. And even though there are all these many issues and complications, maybe there is a buffer, at least in people's inventories, that would be dangerous to try to overbalance right now. That's what I'll be watching.
Okay, thanks, Art. MacroVoices Energy Week is released every Wednesday evening. Next week, we'll have Pat Hemsworth back with us, Chris Cook will be back with us, and still one more panelist yet to be announced will be joining us for next week's show. But before we let this week's panel go, I'd like to ask each of you to please tell our listeners where they can follow your work and learn more about what you do, starting with Art Berman.
ArtBerman.com is where you can find out what's going on, what I'm thinking about. We're in the midst of completely redesigning the website, and hopefully that will be complete here in the next week or two. And you can always follow me on Twitter, AEBerman12, if you want to hear my kind of daily brain burps as to what I'm thinking and what charts I put out.
Pat Hemsworth, where can our listeners find out more about what you do?
Okay, well, I am on Twitter, and it's at P Hemsworth, and so I'm active there. The other thing too is I offered this last week. I write a daily commentary for clients. So if readers would like to get a copy of that, I'd be happy to send it. Only asking that they just tell me what their interest in energy is. So I can be reached at P Hemsworth at ParagonGlobalMarkets.com.
Well, needless to say, from your many decades of experience in the industry, free access to what is normally a client-only report is a bargain that I would encourage our listeners not to pass on. Anas Alhajji, where can people follow your work?
All right. I do put most of the conclusions of my research on Twitter, and I do comment on events immediately on Twitter at Anas Alhajji, ANASALHAJJI. And most of the work, basically, I'm doing outside the private investment work I do, basically, is speaking engagement. So those who are looking for a speaker, they are welcome to contact me through my website, anasalhaji.com. The other point I would like to mention here on this, that all of us, basically, while we talk about oil, this applies to all the three of us. There are other things we do too. So it's not only oil. We talk about natural gas and NGLs and LNG and all energy issues and energy policy and all other things.
Anas, we look forward to seeing you again next week along with our other panelists. For MacroVoices Energy Week, I'm Eric Townsend. See you next week, everybody.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices.